All right, working through a few example problems for the master budget chapter. This is when the company is planning for the upcoming accounting period. So first, let's just talk conceptually about budgets. And so this first problem is just kind of getting us to think through whether each of these items is an important budgeting guideline or if it is not. Okay, in other words, is this really what we want to accomplish in budgets or no? So employees should have the opportunity to explain differences from budgeted amounts. Okay, in other words, when we compare actual results to the budget, should employees have the opportunity to explain why the actual results were different from budget? And the answer is yes, right? We should always give opportunity to explain. Doesn't always mean something bad happened, but we definitely need to use the budget as a benchmark to evaluate actual results. Okay. Budget should include budgetary slack. Okay. Budgetary slack is where when we're preparing the budget, we put a little bit of cushion in, right? In other words, for revenues, we kind of under budget for the amount of revenues that we expect to earn. That way, when the actual revenues happen, we look a lot better, right? If we compare actual results to a lower budget, then it looks better, right? And with expenses, if we overestimate our expenses when budgeting, then when our actual expenses come in under our budget, we look good, right? And should we do that? No, right? Budget should always be prepared based off of attainable, what we think we can attain, okay? So no, we should not include slack in a budget. Employees impacted by a budget should be consulted when it is prepared. Absolutely. It's called participative budgeting. The budget is not just prepared within the accounting department, right? It involves all departments that are covered by the budget, which is pretty much the entire company. Goals in a budget should be set so low targets can always be reached. Nope. Just like we talked about a second ago, we always want to set our budget at attainable, reasonable goals. And budgetary goals should be attainable? Yes. Okay, so now that we've had a chance to kind of talk conceptually through some of the budgeting concepts, let's go through a kind of a large cumulative problem that has us walking through the full master budget for this company Zigbee. All right, so remember the master budget is really encompassing a whole bunch of smaller budgets. So we kind of just need to look at this as preparing a series of budgets which together make up the master budget. What we have here is Zigbee Manufacturing. They prepared the following balance sheet for March 31st. Okay, so this is actual results for March. Okay, so this is where they stand as of March 31st. Then they have provided us a bunch of information. We're going to be preparing a master budget for April, May, and June. So we're going to be preparing a budget for the next quarter, April, May, and June. Okay, so they've given us a bunch of information here. We're going to come back to that. Down here, we're going to take a look at what we're going to be doing. Okay, so we got a lot to do because we are going to prepare the following budget for the months of April, May, and June, except for any additional notes below. All right, so remember the master budget, series of smaller budgets. We always start with the sales budget. That's going to be our first one. So let's go back up here and find out what information they have provided us to help us in preparing a sales budget. Now the sales budget is going to prepare the guidelines or the goals that we have in sales for April, May, and June. So it looks like here they have told us that sales for March totaled 20,500 units. Remember, everything that they're telling us about March were actual results. This is what they sold in March. They are planning for the following sales, budgeted sales, plans. April, they're planning 20,500, May 19,500, June 20,000, and July 20,500 units. Okay, again, all this is in units. The product selling price is $24 per unit, and its total product cost is $19.85 per unit. All right, so they've given us a lot of information here. We are preparing a sales budget to start the master budgeting process. The sales budget is just projecting unit sales and total dollar sales for the next quarter, April, May, and June. All right, so here I'm going to bring the budgeted sales for these 3 months over to my sales budget, and they are planning to sell each of these units for $24 a piece, multiplying the number of units by the budgeted selling price, total budgeted sales in terms of dollars for April, May, and June. All right, we started with the sales budget because in order to prepare any subsequent budgets, we needed to know what the budgeted sales were. All right, so sales budget is done. Production budget. Now that we know the level of sales budgeted for April, May, and June, now we can prepare plans or a budget for how many units need to be produced in order to have enough inventory on hand to earn the level of sales that we just budgeted for. Okay, if we're planning to sell these many units, we need to make sure we have those units available to sell in those months. So now we're going to plan what we need to produce in order to meet our budgeted level of sales. So going back up here, in order to produce the units, I'm going to skip past item B because item B is telling me about the materials needed to produce, okay? And we're going to come back to that because I am going to need to know the amount of materials that are going to need to be purchased in order to produce our units. But right now I'm only concerned with how many units do we need to produce, okay? So I'm going to skip B, we'll come back to that. I'm going to jump down here to C. This is telling me that the company policy, the company wants to have available for a given month's ending finished goods inventory to equal 80% of the next month's budgeted unit sales. All right, a little bit of a word puzzle here. In other words, they want every month to end with enough inventory, finished goods inventory, inventory that's ready for sale. They want their ending inventory to equal at least 80% of the next month's budgeted unit sales. Okay, so for example, April, okay, we are budgeting, let me get this all in one page here. In April, remember, based off of the sales budget, we are planning to sell 20,500 units. Okay, so those are the number of units that we are going to be selling. We need to have 20,005 units on hand. Now, in addition to having 20,500 units in the month of April, we also want to have 80% of the next month's budgeted sales available at the end of April, right? Because they don't want to just completely wipe out all their inventory. They want to have a little bit of extra inventory available. That means we need to have 80% of May's sales on hand at the end of April. So in addition to having enough inventory to meet April sales, we need to have 80% of May's sales on hand at the end of April. So we need 15,600 units at the end of April. So when I add up the units we're planning to sell in April, plus what we need to have on hand at the end of April, I need a total of 36,100 units of inventory available for sale. But I may have started April with some units already on hand, right? I may have beginning inventory left over from the last accounting period. So let me go back in here and see, oh look, they did tell me that we ended March with 16,400 units of inventory. That means if I need 36,100 in April, but I'm starting April with 16,400 units, I only need to produce 19,700. Number of units available, less what we already will have. We're going to budget to produce 19,700 units. Okay. Now that was what we budget for April. Now let's budget for May. In May, we're budgeting to sell 19,500 units from the sales budget. In addition to that, we want to have 80% of the next period sales. So we want to have 80% of June on hand. So in addition to selling 19,500 units, we need 16,000 available at the end of the month. We need to have a total of 35,500 units of inventory available in May. We are going to start May with whatever we ended April with. Remember, we budgeted to end April with 15,600 units. So if I subtract the number of units I'm going to start May with, I only need to plan to produce 19,900 units in May. For June, we are budgeting to sell 20,000 units. In addition to the 20,000 units we're going to sell, we need to have 80% of the next month's sales. All right, well, where do I get that? Because my sales budget isn't budgeting for July. But if I go back over here, I can see that in the original problem, they told us what we're planning to sell in July. Okay, so if I take 20,500 July sales times 80%, I need to have 16,400 on hand at the end of June. Total units I need to have available, 36,400. But I'm going to start June with what I ended May with. I'm planning to end May with 16,000 units. I subtract that from June's inventory needs to plan how many I need to produce. Okay, so the total units to produce for this quarter will be 60,000 units. All right, now that I have budgeted what I plan to sell, based off of the sales budget, I have planned how many units I need to produce for each of those months. Now I can start planning how many materials are going to be needed in order to produce this many units to meet this level of sales. So let's go back up here, and we're going to go back to B now because it's telling me the amount of materials that are going to be needed in order to produce our units. So for Zigbee, direct materials budget for April, May, and June. Units that will need to be produced in each of those months. Guess where that came from? That comes from my production budget. I'm going to bring my budgeted production for each of those 3 months from my production budget. And then I'm going to go back here and see that in order to produce each of these units, each unit requires half a pound of direct materials. So to produce these number of units times half of a pound, the total materials in pounds needed to produce those units is now budgeted. But just like with the number of units, we don't want to only plan to purchase or have on hand the amount of materials needed to just meet the month's production needs, because they told us the company policy wants a little bit of an extra materials inventory equal to 50% of the next month's direct material requirements. All right, so let's figure this out. If we need 9,850 pounds to meet April's production, and we also want to have on hand half of the next period's material requirements, or the next month? All right, well, the next month, my material requirements are $9,950, or excuse me, pounds. If I multiply that times 50%, I need to not only have enough pounds of materials for this month's production, I need enough 50% of next month's production needs. So the total materials required during the month of April are going to be 14,825. The problem goes on to tell me that at the end of March, we already had 4,925 pounds of materials on hand. So I need 14,825 in April, less what I'm starting April with. I now have budgeted the number of pounds to purchase in order to meet our inventory, raw materials inventory needs. So that's in pounds, and they are budgeting $20 per pound. So when I multiply the pounds times the price per pound, I come up with the cost of materials we're budgeting for. Okay, do the same thing for May. Number of units to produce times half a pound each. Total pounds needed for May's production. Less what we're, or excuse me, in addition to that, we need half of the next month's production needs. So for the next month, we need to have on hand half of June's material needs. So half of 10,200 or 5,100. Total materials needed during May, less what we are ending the prior month with. Total materials to purchase at $20 per pound, total budgeted material cost. June production needs at half a pound per unit, 10,200, plus we need 4,000 pounds available at the end of June given in the problem. Total pounds needed for the month of June, less what we are ending the prior month with, starting June with 5,100 pounds. Total materials to purchase, 9,100. At $20 per pound, total budgeted material purchases cost. Okay. Total material purchases in pounds for the quarter and in dollars. All right, what have we done? We prepared the sales budget for the upcoming 3 months, which enabled us to plan our production for the next 3 months, which enabled us to plan our material needs for the next 3 months production. Now we can budget for our direct labor cost for the next 3 months in order to produce these many units to meet these level of sales. All right, let's go back up here and see what information they gave us. They have told us that each finished unit of inventory requires half an hour of direct labor at a rate of $15 per hour. Okay, so in order to produce each unit, let's go back and remember how much we're planning to produce in each month from our production budget, and we're going to bring that forward to our direct labor budget. Units planning to be produced in each of these months. Each unit is expected to require half an hour of labor. Multiply the units times half an hour of labor, total direct labor hours that will be needed to produce those units at a cost of $15 per unit. We have now budgeted our labor hour needs as well as our labor cost. All right, we now have our direct labor budget, and now they want us to prepare a factory overhead budget. So going back up here, remember factory overhead is going to include in all the indirect costs of making the inventory. So they have given us the predetermined variable overhead rate of $270 per direct labor hour. So they are applying overhead based off of direct labor. In addition to that, it looks like it's a very simplified overhead. They just have one fixed cost, depreciation of 20 grand, only fixed factory overhead item. All right, so our factory overhead budget. Now that we know how many hours we're budgeting for, we can plan what our applied overhead will be. At a rate of $270 per direct labor hour, we're going to bring our labor hours times 270 predetermined overhead rate. We are planning to apply overhead for each of the months, 81,000 in total. In addition to that, we are budgeting for our fixed overhead, which consists of depreciation. We now have our total budgeted factory overhead cost. All right, we now have our factory overhead budget, selling expense budget. Let's go see what information they gave us for selling expenses. Sales commissions of 8% of sales are paid in the month of the sales. In addition to the commissions, the sales manager's monthly salary is $3 grand. All right, let's go down here and take a look at our selling expense budget. Budgeted sales comes straight from our sales budget. Go all the way back up here to our sales budget. This is the amount of sales budgeted for those 3 months. Once we know the amount of sales budgeted, we are able to plan for the amount of commissions that we're going to be paying our salespeople. Based off of the budgeted sales, commissions of 8%, sales commissions by month, 115,200 in total. In addition to the commissions we pay to our sales staff, the sales manager has a monthly salary of $3 grand. So we now can budget for the fixed portion of our selling expenses, total budgeted selling expenses per month and in total for the quarter. All right. We now have our general and administrative, we now have our selling expense budget complete. Now we can plan for the other expenses we will incur. Selling, general, and administrative. Monthly general and administrative expenses include $12,000 for admin salaries, and we have a 0.9% monthly interest on the long-term note payable. All right, let's go back up here and see what they mean. Oh, I can see we have a long-term note payable here of 500 grand. And we're going to be paying, where did it go? I lost it. 0.9% monthly interest. So here is our general administrative expense budget. Administrative salaries of 12 grand per month, plus 9% on that long-term loan. 500,000 times 0.9%, 0.009, 4,500. So interest of 4,500 per month, total gen and admin expenses of 49,500. Okay, so let's take a step back. We kind of got lost in some details here. Let's think what we did. We started by preparing a sales budget. Once we were budgeting, or we had a budget for what we expected to sell, we were able to plan a production budget based off of those level of sales. Once we knew what we needed to produce, we were then able to start planning the amount of materials that are going to be needed to be purchased. And in addition to that, we are also able to plan for some of our costs, our direct labor cost, our factory overhead cost, plus our period expenses, the selling expenses and the general administrative expenses. Okay, essentially what we now have done is we have enough information to start projecting how we're going to do financially if we meet our budgeted goals. Okay, so that enables us, we are now done preparing the operating budgets. We are now going to prepare the financial budgets. The first budget we're going to prepare is the cash budget. Okay, so in order to prepare a cash budget, we first need to budget for the amount of cash we expect to receive and the amount of cash we're going to be paying for our materials. So let's start with the amount of cash we're going to be receiving over the next 3 months. The company budgets 30% of their sales to be made in cash, right? Which is telling me that 30% of the current month's sales will all be received in cash. The other 70% of their sales will be sold on credit, which means they won't get any cash that month for those sales. They will get the cash in the future because credit sales are collected in full in the month following the sale. Okay, so they don't collect any of their credit sales the month they have the sale, they collect it the next month. So let's plan what we expect to receive in cash for those 3 months. Okay, going all the way back up here to my sales budget, I'm going to bring my total budgeted sales down to my cash receipt budget. Sales straight from the sales budget. Of those sales, 30% will be in cash. Okay, so I am going to be receiving 30% of April's sales in cash. So I know cash receipts will be 147.6. In addition to that, in April, we are going to be collecting 70% of the prior period sales. All right, I'm looking over here and I do not see anything here telling me what they sold in March. But you know what I do know is I do know on the balance sheet they had reported accounts receivable. That accounts receivable tells me that they had sold to customers on credit in the past. And if all of their credit sales are collected the next month, that tells me that they're going to be collecting or expecting to collect all of that receivable from March in April. So we're going to budget for cash collections of $344.4 for prior month sales. Okay, so let's go back down here now. Okay, so sales of $492, bringing us cash of $492, happens to be the same. All right, May. May, we expect to sell $468. 30% will be brought in as cash for this month. Plus, we are going to be collecting last month's credit sales. Okay, so last month sales were $492. 70% of that was on credit. So we are going to be bringing in cash of $344.4. June sales of $480. 30% will be brought in cash, plus we will collect 70% of the prior month's sales. Okay, 468 times 70% will bring in cash of $327.6. Okay, so now what we have done as we're preparing our cash budget, we now know the amount of cash we expect to be receiving each of these months from our sales. They also need us, or we need to, come up with what we're going to be paying for our direct materials for each of these months. Okay, remember up here, our direct materials, we budgeted for what we need to purchase. Okay, based off of those purchases, we can plan how much cash will be spent for those purchases. But let's find out what their policy is on their purchases. All raw material purchases are done on credit, and their accounts payable are all completely and solely tied to raw material purchases. all raw material purchases are fully paid the next month. So in other words, none of their material purchases are paid in the month they make the purchase. So in April, they're not going to be paying anything for the current month's purchases because they buy everything on credit. They are going to spend cash during the month of April to pay prior month's purchases. Okay, well March, they didn't give me how much was purchased in March. But you know what, on my budget, on my balance sheet, I can see that we are reporting an account payable of 201. And they told me that all of their account payable is tied to purchases of raw materials. And if they pay all of their purchases in the following month, the account payable balance at the end of March will be paid in April. So I'm going to budget to spend cash of 201 in April for my material purchases. In May, I'm budgeting to spend 201 or purchase 2015. All of it will be on credit, so no cash during the month of May for May purchases. But I will pay in May the purchases from the prior month. So I will pay all of April purchases in May. June, amount of purchases needed, none will be paid in June. I will be paying May's purchases. So all of May purchases will be paid in June. I now have planned for what I will be spending cash on in each of these months for purchases of materials. So I know the cash that I will be receiving each month, and I know the cash that will be spent on their materials. We now have enough information to prepare our cash budget. All right, so let me go back up here. In J, they have told me that the minimum ending cash balance for all months is 40 grand. Okay, in other words, the company does not want their cash to fall below 40 grand. If necessary, the company will borrow enough cash using a loan to reach that minimum. Loans will require a 1% interest payment at the end of each month before we can repay any of the loan. If the end of the month preliminary cash balance exceeds that minimum, so any cash over that 40 grand, will be used to repay any loans. Okay, so they don't want to fall below 40. If they expect to be above 40, they are going to repay any loans. Okay, so in addition to knowing that they will be borrowing to meet their minimum cash needs, a little bit more information here. They are going to be paying dividends in May of 10 grand. Additionally, no cash payments for income taxes are budgeted in the second calendar quarter, so we don't need to budget for any income tax payments. The income tax will be assessed at 35% in the quarter and budgeted to be paid in the third quarter. Okay, again, we don't need to pay it now, so we don't need to worry about that for the cash budget. But we do need to budget for equipment purchases of 100 grand in June. All right, we got a lot of information here. So let's plan our cash budget. When we're budgeting, we are going to start with how much cash we have on hand. In April, we are going to start with whatever cash was left at the end of March. All right, well, I go up here to my balance sheet and we are going to end March with 40 grand, which means we're starting April with 40 grand. What are we going to add to that cash during April? Well, we're going to add any cash we get from our sales. You know what? We just budgeted for that. We are budgeting cash receipts from sales of $492. So if we start with 40 and we bring in cash of 492, we expect to have cash of 532 available. Now, what are we going to spend cash on? Well, let's go back and look at all of our production budgets. We know we're going to be spending cash on direct materials. Oops, sorry. Where's our cash budget? I think I went right past it. Oh, here it is. Our schedule of cash payments for direct materials. Okay. We know we're going to be spending that cash. In addition to that, we are going to have to pay our labor. Well, guess what? Up here, we have our labor for each of our months. Bringing that back down here to our budget. Okay. In addition to the cash spent for materials and labor, we also are going to have the variable portion of our overhead. So I'm going to go back up here to my overhead budget. Okay, 81,000 in total. Now remember, the fixed overhead was depreciation. Depreciation is a non-cash cost, so that's not going to end up on the cash budget, but our variable overhead costs will. Okay. So going back down here, we've got our variable overhead. We also are going to have to pay cash for our sales commission, right? So look what I'm doing. I'm going back and going to each of my budgets and pulling the cost that I had budgeted for. Okay, bring that back down to my cash budget. Okay. Sales salaries comes from our sales budget, okay, or from our selling expense budget. Then we have our general and administrative expenses. Okay. There's our salaries, administrative salaries. Okay. Okay. And then our dividends, that is only in June. Our loan interest, wait a second, loan interest. Oh, look, we do have a loan balance of 12,000. And remember, we are paying a 1% interest rate for each month that we have a balance. So if we ended March with a balance of 12,000 at 1%, we're going to have to pay interest of 120. Okay, in addition to that, we also have our note payable, okay, which came from our selling and admin budget. We have to pay our interest on our long-term note. Okay, so for April, we expect to have cash of 532. We expect to spend cash on all of these things. Cash available less our preliminary cash balance, cash spent gives us our preliminary cash balance. All right, so we have 97,675 we're expecting to have at the end of April, way above our $40,000 minimum, which means we're going to pay off as much of any outstanding loan we can. We have a $12,000 loan. We will have enough cash to pay that off in its entirety. So we're going to budget to pay that thing off. Okay, which means we expect to end April with 85,675 in cash. Okay. Now let's budget for May. Okay. We expect to end April with 85,675. Start May with that amount. What are we going to add to it? We're going to add cash from May sales, or May cash receipts. May cash receipts are budgeted to be $484,800, bringing our cash available in May to $570 and change. What are we going to spend cash on in May? We are going to spend cash on direct material purchases, right, which we budgeted for and what we're going to actually be paying in May for our for our material purchases. And then all of our other costs, labor, overhead, sales commissions, all of that stuff that we had brought earlier. So for direct labor, our variable overhead, remember the fixed overhead is depreciation, a non-cash expense, sales commissions, sales salaries, administrative salaries, interest on the long-term note. Okay, bring all of that down here into our cash payments in May. We don't plan to purchase any equipment in May. We don't have any loans. We don't have any interest to pay because we paid off that loan in April. Total cash payments expected. Subtract that from the cash we expect to have available to get a preliminary cash balance. No loan, we don't need to worry about paying anything off. If we expect to end May with $129,420, we expect to start June with $129,420. Again, go through that same process. Cash receipts from our cash receipt schedule. Cash payments of $2,015 for materials and all of our other costs from our previous budgets. And we need to budget for purchase of equipment. Expected balance in cash is $61,080. No loan payment to make, and we don't need to borrow because we're above our 40 grand. Okay, so this problem does go on to complete the budgeted income statement as well as the budgeted balance sheet, which are the last two of the budgeted financial budgets. And those are based off of everything in those prior budgets. But we're not going to go into that. We're going to stop with the cash budget. But just be aware that the next steps would be to take all of our budgets and project what our income would be, as well as what we would budget or project our balance sheet to be. Okay. Again, we're not going to go through it. We're going to stop with the cash budget, but hopefully you find this helpful.